SoFi Technologies, ticker SOFI, is trading live at $29.75, which is a very strong move up of $1.54 or 5.46% during today's intraday session on Monday, November 10th. The stock gapped up at the open and has been pushing higher, trading in a range between $28.84 and a high of $30.15 on significant volume of nearly 40 million shares already. But here is the immediate insight that most traders are missing this morning. This move, this 5.5% surge, is not happening because of some new press release or a major upgrade. It is happening in direct defiance of Wall Street's consensus. As of today, the average 12-month price target from 18 different analysts covering SoFi sits at $26.03. The stock is currently trading nearly $4 above that consensus target. This is not just a rally. This is a fundamental disagreement between the market's momentum and the skepticism of professional analysts. The expectation is that analysts lead the price, but the reality right now is that the price is leaving the analysts behind. Let's establish the common ground, because the bullish narrative is, on the surface, undeniable. SoFi's last earnings report in late October was, by all accounts, a blowout. This was the company's 8th consecutive quarter of GAAP profitability. They posted earnings of 11 cents per share when the street was only looking for 8. They beat revenue expectations, posting $961.6 million against an $887 million estimate. They added a staggering 905,000 new members, bringing their total to 12.6 million. And, most importantly for a growth story, they raised their full-year guidance. CEO Anthony Noto is executing the one-stop-shop strategy perfectly. The flywheel is working. Acquire members with one product, like personal loans or high-yield savings, and then cross-sell them into investing, credit cards, and more. The bank charter, which they fought so hard for, is paying off, allowing them to gather low-cost deposits and fund their own loans, dramatically improving their net interest margins. So, if the company is executing perfectly, why the disconnect? Why is the stock only rated a neutral or hold by the majority of Wall Street? This is where we must separate the company from the stock. The company is performing, but the stock is running into valuation concerns from the big firms. While retail investors and social media platforms are euphoric, looking at the rapidly growing member count and profitability, the institutional analysts are looking at a price-to-earnings ratio of 54 and a high price-to-book value. They are questioning what happens if the economy slows down, if those personal loan default rates tick up, or if member growth finally hits a ceiling. You have Mizuho with a $38 buy target, but you also have Keefe, Bruyette & Woods maintaining an underperform rating. The stock is a battleground defined by this tension. Retail sees explosive growth, while Wall Street sees explosive risk. This leads us to the short-selling narrative, which is perhaps the most misunderstood part of the SoFi story right now. When you see a stock with this much online debate, this much volatility, and this big a gap between bulls and bears, the immediate assumption is that it must be a massive short seller target, just waiting for a squeeze. We looked at the data, and the reality is completely the opposite. This is not a stock under siege by short sellers. Let's look at the facts. The current short interest is about 100.29 million shares. While that sounds massive, it represents only 8.47% of the float. This is a moderate figure, not an extreme one. But the most important number for those hunting a squeeze is the days to cover, which is currently just 1.22. This means that given the high average volume, all 100 million shares shorted could be bought back and covered in just over one trading day. There is simply too much liquidity for a classic squeeze. Here is the actionable insight. The most telling metric is the short borrow fee rate. This is the interest rate hedge funds have to pay to borrow shares to short them. For truly distressed or heavily targeted stocks, this rate can spike to 50%, 100%, or even 500%. The borrow fee for SoFi today is approximately 0.41%. That is not a typo. It is almost free to bet against this stock. And yet, the bears are not building massive, concentrated positions. What does this tell us? It means the current 5.5% rally is not a short squeeze. It is not a technical dislocation. It is genuine, aggressive buying pressure. The longs are winning this battle not by squeezing the shorts, but simply overwhelming them with demand. If you are an investor, you can monitor this data yourself. Public exchanges like Nasdaq publish short interest data twice a month, and platforms like Fintel or S3 Partners track the borrow rates. A spike in that borrow rate would be your first signal that the dynamic has changed. But for now, the bears are quiet. This interpretation is confirmed when we look at the options market. The options chain is where you see retail sentiment in real time. The current put-call ratio for open interest is 0.66. This is definitively bullish. It means for every 66 open put contracts, bearish bets, there are 100 open call contracts, bullish bets. Looking at the volume from last Friday, call volume was more than double the put volume. This is the retail and momentum trading crowd buying up call options, betting that the stock will continue to climb. They are using leverage to amplify the bullish thesis that SoFi's earnings report proved SoFi is the real deal. What do you make of the analyst ratings? Are they behind the curve on this, or is the retail crowd getting ahead of itself? So what is SoFi for those who are new to the story? It started by refinancing student loans for high-earning graduates. It has since expanded into a full-fledged digital-first bank. It operates 3 segments: lending, personal loans, student loans, and home loans; financial services, checking and savings and investing platform, and credit cards; and the technology platform known as Galileo, which is the B2B infrastructure that other fintech companies use to build their own banking products. This diversification is key. When interest rates are high and lending demand slows, their financial services segment profits from higher net interest margin on their deposits. When the market is booming, their investing and lending segments do well. This model is designed to weather different economic cycles, and the Q3 report finally showed all 3 segments firing at once. Looking ahead, the tension remains. The company has guided for strong future growth. They are expanding into new products, like their recently launched SoFi Pay, a global remittance service, and even options trading to compete directly with other platforms. The bull case is simple. SoFi will continue to take market share from legacy banks, its member growth will continue, and its cross-selling strategy will make each member more profitable. As profitability scales, the high valuation will be justified, and the analysts will be forced to upgrade their ratings and chase the stock higher. Comment below with your own price target for SoFi by the end of 2026. The risk, however, is not the short sellers. The risk is macro. SoFi's customer base is high quality, with high FICO scores, but a severe economic downturn would still test its loan book. If employment ticks up, default rates will follow, and that would hit SoFi's bottom line hard, proving the skeptical analysts right. The future of this stock depends on its ability to maintain its growth trajectory in an uncertain economy. For the coming weeks, the signals to watch are twofold. First, watch the options market. Does that bullish call volume continue, or does it fade as the stock hits the $30 resistance level? Second, watch analyst actions. The real catalyst for the next leg up would be if one of the major hold-rated firms like UBS, JP Morgan, or Goldman Sachs capitulates and upgrades the stock, admitting their $26 targets were wrong. To summarize, SoFi is in a fascinating position. The company is executing flawlessly, delivering